All right, I think we will get going here. First and foremost, I'd like to welcome everybody to the "What is my small business worth" webinar. My name is Tyler Blackwell, and I'm the community manager at the Rossi Group. I'd like to take this time first and foremost to introduce our guest speaker today, Daryl Ching. He's managing partner of Vistance Capital. Over the next hour, we're going to touch on a few different items, mainly to do with small business and the finances that lead up to the success of your small business. So I think Daryl's going to touch on creating a proper business plan, proposing to investors the proper way. That way you're making sure that you tick off all the boxes. So it'll be financial plans, it'll be a wide variety of different tips and tricks to make sure that you're putting your best foot forward when you are proposing your plans to the investors. We are going to have a Q&A session at the end of the webinar, probably about the last 15, potentially 10 minutes. So if you are looking to have any questions answered by Daryl throughout the session, feel free to use the chat piece at the bottom. You can quite simply just move your mouse to the very bottom, click on the chat feature, and you can type. Make sure that you do select two. You have either the option of sending to all panelists or all panelists and attendees, depending on who you want to see your question. You can choose a different option for who your question is going to go to. Without further ado, I think I'm going to turn it over to our special guest for the next hour. Daryl Ching, managing partner of Vistance Capital. I'd like to welcome you and thank you very much for taking the time today.
Thank you, Tyler. I thought maybe I'd start by talking a little bit about my background. My background actually is in investment banking. So I spent a decade screening transactions for investors. And what I found was a lot of deals fell through the cracks, not because of the companies not operating well, but because there was a simple disconnect in communication between entrepreneurs and investors. So a lot of companies are great at conveying their vision. They convey a lot of passion. They're good at expressing their pain point in their products. But on the other side of the table, you have investors holding a checklist and saying, well, did they check all these different items that I have on my list? And this is the precise list I'm going to be going through today. And a lot of deals fell through. So when I left investment banking, I actually saw a huge opportunity to take the knowledge that I have on the buy side and help investors prepare the appropriate materials so that they can be successful in their capital raise. One of the most common questions that I get asked as a consultant is, hey, Daryl, can you prepare me a valuation report? And this is really what prompted me to do this seminar, was that I asked, why do you want a valuation report? Well, I just want a valuation independent valuator so that I can go raise capital with it. And I say, I'm happy to do it, but it's not going to help you raise capital, especially for small businesses. So applying some of the things that you learn in business school, such as a discounted cash flow model or using multiples based on comparable public companies, it works for mature companies. But unfortunately, if you're small with less than 2 million, 3 million of revenue, it's not going to work for you. It's a lot more subjective, the entire process. And this is one of the things that I stress to my clients. The Canada and US market are quite different. US has more depth. So when you go raise capital in the US, you're going to come across investors that specialize only in one industry and really understand the industry. In Canada, because we have a smaller market, we have investors that I would deem generalists. So it's not uncommon to have an investment analyst that covers mining, oil and gas, and technology. So what you have in Canada are more networks that actually have a general knowledge of several industries, but not an in-depth knowledge of one. And so they rely on checklists to make their business decisions. And that's really sums up the difference between the markets and why we have to approach investments differently in Canada. Another update is that the capital raising process for angel networks and VCs really grinded to a halt on March 15th when the pandemic hit. And a lot of the capital raising initiatives that we had started were all put on pause for several months. I would say starting in the last month, we've started seeing some activity again. And in fact, what investors are now focusing on is how companies pivoted through the pandemic, because this has been a true test of adaptability. If you have pivoted your business, figured out how to create new revenue streams, you're being rewarded. So really, it's not so much the big eating the small, but it's actually the fast eating the slow right now. And so if you're in that camp and you need capital, then it's a great place to start. So I'm going to share screen right now and go into the PowerPoint presentation and launch the slideshow. So give me a second here. Okay, let's get started. Really, the focus of this presentation is on early stage companies. So you're either raising seed money, so you're in a concept phase, you're pre-revenue, or you're self-funded. Typically, what happens in this phase is that you raise money through friends and family, and in some rare cases, angel investors. The investors tend to be a bit more passive. There's less documentation required, and the due diligence process is pretty simple, and you can expect a valuation of anywhere between 500,000 to about 3 million. Where we really get involved is Series A, where you have arrived at an area where you have proof of concept, you have generated some revenue, but probably less than 2 million. Once you get to that phase, a lot more doors open up for you. You can approach angel investors, venture capital firms, and private equity. The mix of investors is still pretty large. Some are passive and some are very active. In some cases, there are investors that will be strategic investors that are going to want to run certain parts of your business. They're going to impose restrictions and requirements if you want to pivot your business or strategy. And so really, it's choosing the right investor is very crucial at this stage. For Series A, you're looking at a lot more detailed documentation requirements, and which I will go through throughout this presentation. And you're going to go through a thorough due diligence process where they are going to check a number of items as they go, because it's not likely that you have audited financial statements. So they are going to want to look through your financials. They're going to want to dig through bank statements. They're going to want to dig through contracts. The investors tend to be more sophisticated at this stage, especially the institutional ones. And you can see valuations typically anywhere from $2 million to $10 million. The first variable that investors are looking at, and I think this is the most important one, is the strength of the management team. But ironically, it is an area in a slide deck that is often ignored. I've been to many presentations before where people put up 4 photos of the management team and their titles. And sure enough, when the Q&A comes, investors start asking questions and they say, well, tell me about your management team, tell me about your backgrounds. And, first and foremost, have you ever built a business before? Have you grown it? And have you successfully sold a business? If you have, then that's something you should immediately highlight. To show an extreme example of how important the strength of the management team is, if somebody like Jeff Bezos or Elon Musk started a business and all they had was an idea, they could probably get a $50 million valuation just because of their track record. The next step is the completeness of the team. There's several facets in a business. There's running and growing a business, there's sourcing product, there's manufacturing and ensuring that you have plentiful supply, there's branding, there's different sales channels and ensuring that you have proper distribution channels for your products, and there's technology. And to the extent that you have a diversified team that checks all these boxes and has expertise in all these different areas, you become stronger in your valuation. And if you are lacking in some of those areas, then the investor is going to ask, well, how do you plan to plug that gap? Are you bringing in an agency? Are you bringing in a group? Are you planning to hire that in year 2? And so all these questions need to be answered. Are founders coachable? This is typically a deal breaker question. Investors want to see that you are flexible and you're willing to pivot and change with market conditions. You'll see some CEOs that are hard and fast in their business plan, are not willing to adjust. When investors see that, then the deal's out the door. A lot of times deals just fall through right on the spot. Related to that is the CEO willing to step aside if necessary? And the reason why I put that point in there is because there's a recognition by investors that some entrepreneurs are very good at starting businesses, but they really take the business to $2 or $3 million of revenue and they get stuck in neutral and they don't know how to grow the business beyond that. And growing a business from 10 staff to 50 staff and growing a business from 3 million revenue to 20 million revenue is a completely different skill set in terms of putting in processes and procedures and scalability so the company can function at a higher level. And if you are a CEO who's good at starting a business, but you haven't really grown a business to a certain size, that's okay. You just have to recognize that that is a shortfall in your skill set, and you have to be willing to step aside when a company reaches a certain level that can take the business to the next level. The final point I'll make is for B2B. A lot of successful transactions happen when an individual has spent a lot of time in an industry, particularly in B2B. And I'll use an example. If you're in the hospitality industry selling technology and you've been in that space for 20 years, if you want to start your own business offering technology to hotels, that's a business that makes sense from a management team perspective, because you have contacts in the industry, you have a client base already, you already have a deep understanding of how the technology works and what the needs are of your clients. So you're not starting from scratch. So a lot of successful investments happen with people applying 20 years of experience in a space and launching their own business. Proof of concept, I think, is a concept that's definitely misunderstood and means different things to different people. But I will explain how generally investors think of proof of concept. Revenue is the greatest proof of concept that you can possibly have. If you're pre-revenue, you flat out do not have proof of concept, no matter how far you've gone. And it's also the type of revenue that you've gotten is an important distinction as well. So if you are in a position where you have launched a Kickstarter campaign and you've got a bunch of people that are buying your product on Kickstarter, that's not necessarily a proof of concept, because it is designed as a website for entrepreneurs to support entrepreneurs. You're often selling your product at a discount, and it's not proof that people will pay full price. If you are a technology company and you've gotten a large corporation to do a beta test, and you've got 10,000 users because you've got a company doing beta testing or at a price of zero or a discounted rate, that's a partial proof of concept, but it's not a full proof of concept. That doesn't happen until you have customers paying full price. Have you completed a survey with 50 to 100 people to validate your concept? And typically arm's length people. If you've got people that are just your family and friends, that's not really a solid sample set. And having testimonials from 20 people saying your product is great is not a proof of concept either. As part of the proof of concept, you're going to want to prove that your marketing strategy works as well. So that's a segue into the next slide in terms of the go-to-market strategy. The go-to-market strategy segment of your presentation is probably more important today than ever before. It's replaced supply chain. Previously in investment banking, we would spend a lot of time doing due diligence, asking questions about the supply chain, your ability to produce product, but this has eclipsed it. And the reason being is that the landscape for sales and marketing has changed significantly. 20, 30 years ago, you could put an ad on TV when a show is playing, like Friends. You could put out a radio ad on Chum FM or 680 CFTR, or you could put an ad in a newspaper, and you'd immediately get hundreds of thousands of eyeballs, and you'd reach your audience, just because there weren't that many different mediums that people were watching for content. Well, fast forward the clock. You have PVR now, so people don't watch TV commercials anymore. People are now listening to Spotify in the car, so they're not necessarily listening to radio stations, and there's a lot more selection for radio. And people don't read newspapers anymore, quite frankly. So it is far more difficult now in order to reach an audience than it was before. So there's going to be a lot of questions on the depth of the sales, marketing, and branding on your team. And to further that idea, I believe that a company that has a mediocre product but has a solid branding strategy has a better chance of success than a company that has the best product in the world but has no branding strategy. So that's how important this component has become. So I typically see slides that say, okay, we're going to invest $10,000 a month into sales and marketing, and we're going to do Facebook advertising, we're going to do Twitter, we're going to do SEO. And that's not really what investors are looking for. They're looking for more depth there in terms of your background in building successful brands, because people now buy brands, they don't buy products. They're going to look for the fact that you've tried different avenues of branding and marketing, what channels you've used, what was your conversion to sales, and proof. And maybe once you have some of that proof and you have that data, you can expand that and say, and show what you could do with a larger marketing budget. The size of the market, I'll focus on for a little bit here. The size of the overall market typically is not as important as the niche that you are targeting. And if you are a company that says, well, I'm going after a whole market that's multi-billion dollars, I think investors begin to question that you might be trying to chew too much. And so really, how you hit a home run for the market size is to identify an underserved niche that you are targeting that really hasn't gotten the attention that it should. And that's, I think, where you hit a home run in this segment of your presentation. If your business plan involves entering other jurisdictions, investors are going to want to see that you've really thought out the regulatory complexities of entering other jurisdictions, the costs, and the different marketing strategies, because there's different strategies for entering different jurisdictions, different cultures, and understanding an understanding of how you get into the different demographics is extremely important. With respect to competitive landscape, obviously the stronger your competitors and the more saturated your marketplace, the less desirable your business plan, the less desirable the investment. How unique is your offering is important. If your offering is quite unique, you've got a brand new product, you could argue that you have a first to market advantage, that if you were to get your product out the fastest and brand as quickly as possible, you might develop a loyal customer base that will stick with you, and it will not really run to copycats as they come out into the marketplace. Barriers to entry is a big one to address, because if you are, the best scenario is high barriers to entry, but you've already crossed those barriers. That's ideal. And I'm going to give you an extreme example. Let's look at the cannabis industry over the last couple of years. This is a highly regulated market because it's new, and it was really difficult to acquire a license from Health Canada to grow and sell cannabis. And they were very selective. They were restricting the number of licenses they handed out, and it was a 2-3 year process. So if you were successful in obtaining a cannabis license and you went out to raise capital, you could immediately raise capital at a $25 to $50 million valuation just by having the license, because of the high barriers to entry. And so that's an extreme example of one, but it highlights the importance of crossing barriers. The other barrier that is less attractive but works is if there are low barriers to entry, so they're low cost to enter the market, but there is a high reward for first to market advantage. Then you can enter the market and argue that you can get first mover advantage, and the first mover advantage will allow you to soak up enough market share that it'll be difficult for other people to catch up. Then the discussion comes to intellectual property and patents. Can you protect your idea? And to what extent can copycats come out? So if you're able to patent your ideas effectively, so that copycats cannot replicate your product, then obviously that is ideal. And investors will gauge the effectiveness of these patents in different jurisdictions in terms of how easy it is, because the biggest question you're going to get asked is, well, what happens if a behemoth sees what you're doing and just pumps a whole bunch of money into R&D and starts replicating your product with a massive budget? Financial projections, I typically find, are the key differentiator between a good presentation and a bad presentation. So when you sit in a room and you listen to 5 investor presentations, CEOs are typically very good at conveying their vision, their product, and conveying passion. They are typically not good at doing financial projections. Most entrepreneurs are not accountants, and they don't do a very good job in this space. So a presentation where a CEO presents financial projections really well becomes a differentiator, and it becomes a standout in the crowd. So, they're going to want to see that the team has some expertise in accounting knowledge, and that you have the ability to acquire financing through funding operations, and if you have a history of capital raising in the past, that's attractive to investors. They're going to want to see that you have well thought out projections with strong assumptions. And the most typical graph that I see is a hockey stick revenue graph that says, yep, we're going to double revenue every year. Here are our projections. And that just doesn't cut it anymore these days. When you show your profit and loss, there's got to be a justification for your revenue growth. So if you're going to say that you'll double your revenue every year, how do you justify it? Well, do you hire salespeople? Do I see an uptick in sales because you've brought in salespeople? Do I see a viral component in that people refer your product to other people? Do I see a reflection of your branding strategy and how it translates to revenue in your projections? With respect to gross margins, they're we don't want to see that you have really spoken to your manufacturers when you manufacture product and already just looked forward and discussed volume discounts as you grow your business, as you scale and you make larger orders. So for example, a solid presentation shows, well, my cost of goods sold is $5 today, but I can bring them down to $3 if I start ordering a certain amount of volume. And it demonstrates that you've looked forward, and you've demonstrated that you have looked into the ability to lower your costs as you scale your business. With respect to operational expenses, it's very typical to see a company show a base of operational expenses in year one, and they just increase operational expenses by 20% each year. Well, have you thought about the fact that you're going to have to hire executives as you grow your business with higher salaries? If you have a headcount that doubles, have you thought about the fact that you're going to move offices, that you're going to need to do rent? You're going to increase your rent. You might have to buy furniture. There will be moving costs. And they're really looking for specifics. What I really want to stress here is no investor is looking for you to have a crystal ball and accurately project out what your business is going to do in 3 to 5 years. That's impossible. Conditions will change. You're never going to meet your targets 100%. But what they're looking for is that you have a well thought out budget and you have a solid understanding of what requirements and components are there as you grow your business. Balance sheets are often not created, but if you do create a balance sheet, investors are looking for the efficient use of leverage to finance your operations, your ability to understand how to use leverage as you grow your equity base. And they're looking to see that you've properly capitalized your fixed assets. So for technology assets, for example, research and development can be capitalized as an intangible asset. That's a demonstration of an understanding of accounting. And a lot of times I don't see cash flow. And without the cash flow, the investor asks, well, how do you know that the capital you're asking for is enough to get you to achieve your milestones? So you have to create a cash flow, and the cash flow has to demonstrate what milestones you're going to hit when you raise this current round of capital. Are you going to need to raise capital again in 6 to 12 months? And that's okay if you do, but you have to demonstrate that you know that that's a requirement, and a demonstration that you know that the capital is required in the future, and your use of proceeds should match what you have in your investor presentation. You'll be surprised at how many times an investor deck will show use of proceeds for certain items, and then you go to the cash flow model and it doesn't match. So these are really the summation of all the different variables I think are crucial. And what investors will do is they'll look at your investor presentation and they'll score you on each of these categories, and they'll have different weightings for these categories. If you score very high, you'll get the higher end of the valuation, let's just say $10 million. If you score low, you might be at 1 or 2 million. But one thing I want to stress is that one of the things that investors are looking at is your company investable at all? Going back to the valuation report, it's not true that there's a valuation for any business. If 99% of businesses fail for startups, and are you the 1% that's going to succeed? And you really have to prove to investors that you are the 1% first and foremost, and the valuation really comes second. In terms of exit strategy, investors are going to want to know that you've thought this out. Are you the type of company that is long-term, that you intend to run this for the next 30 years? Or are you looking for a 3 to 5 year exit? Because there's different investors for different types of businesses. If you look to run the company for long-term, that's okay. There's investors that are looking for good cash flow businesses that will pay dividends. However, there are a lot of angel and VC networks out there that are looking for 3 to 5 year exits. And so they're going to start asking questions about, well, what is your exit strategy? Okay, if you plan to IPO, have you looked into the public markets to see what the conditions are for going public? Have you looked into valuations? How does the investor base look at valuations for this particular company in this particular industry? Are you building your business to max your valuation if you IPO? Have you looked into acquisitions? What are strategic companies looking for when they purchase other businesses? And are you addressing those needs so that you are attractive as an investment when it comes time for acquisition? And really what your strategy is in terms of exit will dictate the right type of investor for you. I've talked a lot about the capital raising phase of valuation, but let's look at considerations for acquisitions. I've done a lot of engagements for mergers and acquisitions where I've done due diligence for buyers, and I've acted for sellers as well. And so these are some of the issues when you're outright buying companies. And the question, number one question is, can the company operate efficiently without the CEO? A really good barometer for me is to take a meeting with the CEO for 3 to 4 hours on any given day and see how many times the CEO gets interrupted by the staff. And if somebody is coming in every 15 minutes because they need to run something by the CEO to make a day-to-day decision, the company is not operating efficiently. And it is common for entrepreneurs when they start to be micromanagers and want to make every decision. But then your staff becomes less empowered, they're less able to grow the business, it becomes unscalable, and this is something that's very unattractive to an investor. So when I talked about the growth from a small to mid-sized business, we're talking about scalability in that, can I grow the revenue by double and the company will still operate efficiently because it's a well-oiled machine? Do you have documented processes for HR, sales, quality assurance, financial policies? If your salespeople are giving credit terms to customers, do they have guidelines they can follow so they can provide credit terms, or they have to ask the CEO every time? The quality of the financial statements and budget forecasts is important because it shows your ability to be prudent and manage budgets. Your access to financing facilities is a key component. If you have solid access to banking facilities, that's a plus. If you have access to manufacturers, distribution channels for sales, that's a plus. Shareholder debt becomes a contentious issue because it's very common for business owners to have put money into the company and have it as debt that they want repaid. And I've seen deals fall apart because of shareholder debt, because investors don't want to be putting in money and having half of it flow out to pay back a shareholder or owner. So minimizing that shareholder debt is crucial, or being willing to convert it to equity. I'm going to move on to nepotism and personal expenses here because it ties to shareholder debt. To the extent that there are a lot of small family businesses out there, having family members in the business is not a strong suit from the investor's perspective. Wrong or right, there's going to be assumption from investors immediately that the person is not the most qualified for the job, and potentially that this person doesn't even work full hours because they're given family privileges. So you're going to have to go a long way to prove that this is the right person for the role. And to the extent that you have personal expenses, like we've seen businesses where there's 3 personal cars expensed on the balance sheet, that's going to be scrutinized as well. And if you do have shareholder debt, what the investor might do is make the assumption that, well, you've repaid yourself because you have all these personal expenses, so let's wipe that out. So if you're succession planning and looking to sell your business, you want to be very careful about these things, these liberties that you had as a small private business, and start to ensure that you remove a lot of these obstacles as you go through the acquisition process. Earnouts are very common now with acquisitions. If you get an outright acquisition where someone's willing to pay 100% right off the bat, take it. But what a lot of investors have realized is buying companies outright and keeping CEOs for a year for succession planning, they don't become very motivated after they've sold all the shares of their business. So it's a lot more common now for earnouts where you have to meet certain targets in order to get your full payout, so that the CEO becomes very motivated. And remove the emotion. A lot of CEOs that I've talked to said, well, I don't want certain people to be fired because they've been with me for 20 years. Well, one of the issues will be when an acquirer comes in, what they view as key people may be different from what you view as key people, depending on what they have as resources and skill sets. You're going to have to be prepared once you sell your business that they are going to all be the ultimate decision makers on who they keep, how they run the business, and how they dictate strategy. And so if you are going to have trouble with that emotion, and it's going to hurt if they pivot the business in certain ways, you might want to reconsider selling your business at all. So that concludes my remarks. I know that I went through a lot of these slides very quickly. I could dive much deeper and do a full presentation on each of these segments. And so we're curious about the interest that you have and what questions you have, where you would like to focus. And so at this point, I'm going to turn the floor back to Tyler, and so he could host the question and answers.
Perfect. Thank you very much, Daryl. I know That was a lot of information for everybody to absorb in a small amount of time. As I mentioned in the chat, and as Daryl has on the last slide here, he is open to further communication with each and every one of you. If there's anything that he hasn't covered off, that he didn't elaborate quite enough on, or that you'd like a little bit more information on, you can reach out to Daryl via email or by phone. I put that contact information in the message board as of right now. So I think without further ado, we'll go to the questions. I think first and foremost, before we get to the first question, I know Mira, you were quite active in the message board. I do want to thank you for that. Mira was very thankful for quite a bit of the content that you were going over, Daryl. So I did want to mention that to you.
I know Mira very well. We've worked together at Keiretsu.
Perfect. Okay, great. So I think I'm going to start out with a question from Antonella, and she just prefaced her question with she provides bookkeeping services and focuses a lot of time explaining shareholder debt to owners. So she was thankful for you touching on that. Her question to you, Daryl, is how do you help owners shift their thinking from managing year-end for tax versus future growth?
Yes, that's a very good question, Tyler. And in fact, to me, the reason why we get the accounting business is because of this mentality. A lot of accounting firms out there really are focused on just tax, making sure that they comply with IFRS guidelines and CRA. And with that type of thinking, you're never going to grow a business. To me, you're a successful CFO or accountant if you can produce financial statements that a CEO actually wants to look at and is going to use as a tool. I call this management accounting. So for a lot of our clients, we produce monthly financial statements with KPIs, and we do analysis on it every month, and we show the CEOs, look, like this is where you fell short here. You notice that the margins are falling short here for this product line. Maybe we should reduce costs here. And it's an ongoing coaching requirement. And as soon as you can produce financial statements that a CEO can understand, and B, they see the implications and the ability to actually use the information to grow the business, they are going to love the accounting. All of a sudden, you go from being a cost center to being a valuable member of the team and providing valuable insights. So that is very crucial transition from going from just being perceived as a cost center to being a valuable resource.
Perfect. Thanks, Daryl. I hope that helped to clarify for you, Antonella. If not, as mentioned, you can contact Daryl for a little bit more information. Daryl, we also got a question from Spencer Anderson. He was wondering, what do you think the long-term forecast for Canadian venture funding is? In addition to that, are companies better off looking for capital abroad, or will Canada rebound quickly?
Yeah. And so my understanding is that the rebounding has already happened here. And again, to restate one of the points that I made earlier is that a lot of companies are being rewarded for COVID. And COVID was seen as having a devastating impact on the economy, devastating impact on the investor community, but it also presented opportunities because we've never seen a test like this in terms of pivot strategy. So companies that have adapted have proven a lot of things that they probably wouldn't be able to prove in good times. I believe that the Canadian market continues to grow. I believe the Liberal government is supportive of helping private equity grow with venture capital, with groups like Mars in Ontario. They're heavily promoting small businesses. And so I think it's a great place to grow. The only caveat that I have is that my experience in Canada is, and the drawback that I see is that a lot of the investors are generalists. And so if you are in a really, really specific niche product that is complex and difficult to understand, it may be more difficult to get investment than some of the more sophisticated investors in the US that really specialize in one space. And so that's the caveat I have for that. Also the requirements for Canada in terms of size of company are less restrictive than the US. When you go down to Silicon Valley, people are going to be looking for 15 million in revenue at a minimum a lot of times. So the doors open a lot more for smaller size businesses. And I think Canada will continue to be a great place to raise capital.
Perfect. And that's a great answer. Spencer, I hope that that kind of clarifies what you were looking for as well. Daryl, I think I'd like to ask you a question myself. I know that you had touched on the cannabis industry almost being impenetrable, but at the same time, when these investors got proposed a business plan from a company who had received the right to be able to grow, that it was almost a slam dunk. Is there any other industry that you foresee coming up in the future, aside from cannabis, of course, that is going to become that secure when you're going to an investment?
Biotechnology is the big one that I could think of. In fact, a lot of biotechnology presentations that I see have zero revenue, but they're able to acquire large amounts of capital. And it's because the onerous process of FDA approval and the regulatory approvals across countries. If you have a drug in testing that is a game changer and you've reached certain levels, that is an area where all of a sudden you can have a massive valuation pre-revenue. As I mentioned, I touched on a lot of different industries and there are a lot of general comments, but there are nuances for specific industries. And that's one that I can immediately think of that comes to my mind as one where massive barriers to entry, you pass any of these hurdles, you get a massive valuation.
And just to build on that question, I think, and to the opposite, are there any that have been slam dunks in the past that are no longer looked upon as that, and it's more difficult, or they become more touchy for an investment standpoint?
So I'm going to go back to cannabis, and you'll see that the valuations have shrunk significantly. Supply has opened up when legalization of the retail happened, and what happens sometimes in markets is that it starts off as restrictive, but then there's a flood of supply just because everyone tries to get into the market. Let's look at the PPE market right now. If you were in the PPE market when COVID hit, you were a winner because there was a shortage of masks. Now everyone got into the market and there's a flood. So markets do adjust, and there's based on supply and demand. And you're going to see that markets one day that were attractive will not be attractive later because they become saturated. So, but I think pricing and the capital markets is a good regulator in terms of making markets attractive. If it becomes too saturated, you're going to see people leaving the market, and it becomes an attractive industry again. So everything moves in cycles.
Perfect. Okay. Yeah, that's exactly what I was looking for. I know that you and I had spoken in the past about the cannabis industry particularly, and that was sort of the case that you had kind of informed me of. I think that's it for the Q&A, unless there's anything else that anybody would like to propose to Daryl. If not, I do want to thank everybody for taking the time today to join us on the webinar. Again, I can't emphasize enough how thankful we are for Daryl to take the time to lend his information and his expertise in the subject. And again, if you are a small business owner, operator looking for more information, perhaps some services that may help you take your business to the next level, certainly you can reach out to Daryl and his team, and they can.
Tyler, I see a question.
Oh, yep, I do see one. Yep, thank you very much. So I've got a question from Hugh. Thank you very much, Hugh, for sending that through. And the question is, what are the key steps companies should be making to prepare for funding a year in the future?
Yeah, and so really it is making sure that you check all those boxes. So we talked a bit about proof of concept, and we talked about the marketing strategy. What you want to do is put yourself in a place where you're getting high marks on all those categories that I went through in the presentation. And so it's refining your marketing strategy so that you are efficient. You've brought your cost per acquisition for customers down, and you're very efficient at it, and you have the data to support it. You've got revenue so that you've got proof of concept. If you are selling a product, you are able to you've proven that it is a real pain point. Your customers are really willing to pay full price for it. You want to bulk up your management team, so you tick all those boxes on your management team, and you want to make sure that you have very strong financial statements. One of the things that a lot of companies have when it comes to financials is they have consolidated financial statements for their entire business. But when they get a specific question like, how are your margins? How do you break out your profit and loss between division A and division B? What are your margins between product A and product B? Entrepreneurs actually a lot of times are not able to answer those questions. And that's perceived as a weakness by investors, because by separating out profit and loss and separating out these different items, you're better able to determine where you should put your resources in your business. And sometimes we go through this exercise and entrepreneurs all of a sudden find out they're actually losing money in a certain division because they've allocated too much resources to it. Something you wouldn't have known if you had just one set of consolidated financial statements. So that's part of the management accounting process that we go through with our companies to make sure that they are ready. But you want to put your best foot forward, and you know that you've done a good job if you've presented to an investor and they have no questions. That's a win from my perspective, and you've checked all the boxes, and they're scoring you 10 out of 10 on all the different categories presented in this deck. And a lot of times it's prudent to wait a year and get there, because your valuation becomes much higher after you've achieved a lot of these milestones. People that are in a rush to go to market and try to raise money in a situation where they haven't checked those boxes, you're either not going to get the investment at all, or you're going to come in at a very low valuation.
Perfect. Thank you very much for the question, Hugh. I hope that that was the clarification you were also looking for with your question. Daryl, tell everybody where they can find you. Social media, website, phone number, email. Let everybody know what the next steps are and how they may be able to utilize your services.
Sure, Tyler. Unless we're running out of time, I saw another question that popped up in the chat.
Yes, perfect. Stephen, thank you very much for proposing. I appreciate that. Stephen's question to you is, what's the best way to advertise to investors for the sale of your business without going to general public?
So the most typical way that I have seen businesses sold is through investment bankers. So investment bankers typically act as agents, and they are really agents. And it's my previous business. I mean, I was there at RBC Capital Markets, and I was at Coventry, and I was at Ubiquity. And our mandate was to match investors with potential businesses for capital raising and for sale. And investment bankers typically charge a commission or a success fee for selling companies. And so that really is the most common way. There are agents out there, and there are agents that specialize in different businesses. If you want to go through your own path, I see people doing it on LinkedIn. It's a popular forum now. If you put it out there that you were looking to sell your business, you can use some of the digital marketing platforms that are available to you. But the most typical way is through the investment banking industry to sell your business, and coming through groups like us. Now, we are not an agency, we are a consulting firm. And what we do is we ensure the companies are fully prepared and ramped up so that they are able to maximize their valuation through a succession plan. And so, but we do have contacts, obviously, for a lot of investors that say, yeah, I'm looking to buy businesses in this industry. So if you know anybody that's selling, let me know. We do come across that a lot. And so those are probably some of the most common ways. I've heard before that people are using TREB and like so the real estate board and other avenues as well. But those are the most typical ways.
Thanks, Daryl. Stephen, I hope that that was the answer that you were looking for. If not, as I have mentioned in the past year or over the last hour, there are ways for you to get a hold of Daryl after the webinar, should you need to. Just seeing here, is there any more questions that anybody would like to answer while we have Daryl on the floor? Okay, in the meantime, Daryl, like I say a minute ago, if you could let everybody know where they can find you and more information on Vistance, I know that everybody's probably would benefit from that.
Okay, yeah, I'm just going to pop up the screen again. It's that's my email, phone number, and website. So if you want, if you have additional questions, you want me to dive deeper, happy for you to reach out and we can connect. We're also looking at doing a series of webinars, and so if you found this content helpful, and if there's really areas that you would like to zero in on and really focus on. We're open to that feedback because we would like to do more of those. And thank you again for participating. And I've enjoyed presenting the information, and I hope you found it valuable.
Yeah, and again, thank you very much, Daryl. We really appreciate you taking the time today to lend your information, your expertise in the field. So we do wish that everybody has a great rest of the day. Stay hydrated. It's warm out there, and we'll see you all soon.